Hello everyone, welcome to the second video in the Investors Atlas course, an intro course on investing. What are we going to go over in this video? In this video, we're going to go over investment vehicles. We're going to go over an explanation of stocks, bonds, mutual funds, ETFs, and other common investing options, and we'll go over the pros and cons of each investment vehicle that we discuss.
Before we dive into the contents of this course, check the description under this video for a Google form.
If you've already done the Google form, then you don't have to fill it out. But if you haven't, we strongly recommend that you do fill out the form and then continue watching the video. What are investment vehicles? Investment vehicles are financial instruments or products that individuals and institutional investors use to invest their money with the aim of generating returns. These vehicles provide various ways for investors to gain exposure to different asset classes, such as stocks, bonds, real estate, and commodities. The choice of investment vehicle depends on factors like risk tolerance, investment goals, and time horizon.
Explanation of stocks, bonds, mutual funds, ETFs, and other common investment options. Stocks are a ownership of shares in a company. Bonds are debt securities representing a loan to a government or corporation. Mutual funds are pooled funds managed by professionals investing in various securities.
An exchange traded fund is an investment fund that's traded on stock exchanges. Other options include certificates of deposits, which are fixed-term financial instruments offered by banks where investors deposit a specific amount of money for a predetermined period, earning a fixed interest rate until maturity. Then there's options and futures. Options and futures provide investors the right option or obligation futures to buy or sell an asset at a specified price on or before a future date, allowing for speculation or hedging against price fluctuations. There's savings accounts, which are interest-bearing deposit accounts held at financial institutions, typically banks, providing a safe place for individuals to store and accumulate their money while earning a modest interest rate. There's also hedge funds, which are investment funds managed by professional portfolio managers employing various strategies to maximize returns for their high net worth clients, often utilizing leverage and alternative investment techniques. There's also retirement accounts like 401ks and IRAs. These are basically tax advantage investment vehicles designed to help individuals save for retirement. Contributions are often tax deductible, and investment gains within the account grow tax deferred until withdrawal during retirement. There's also alternative investments like cryptocurrencies. These investments encompass a wide range of non-traditional assets, creating cryptocurrencies like Bitcoin and Ethereum. Those are the two most popular ones. These investments diverge from traditional stocks and bonds, and their value is often more volatile, attracting investors seeking diversification and potential high returns, which also makes them pretty risky.
The pros and cons of each investment vehicle. Stocks. The pros of stocks are potential for higher returns through capital appreciation, the ownership in growing companies, liquidity as stocks can be easily bought or sold on the stock market. The cons of stocks are high volatility and risk of significant price fluctuations, no guaranteed income as dividends are not guaranteed, limited control over company decisions for individual investors. The pros of bonds are regular interest payments provided by predictable income, generally lower risk compared to stocks, capital preservation as bonds return the principal at maturity, and the cons of bonds are fixed interest rates may lead to diminished purchasing power in inflationary environments, interest rate risk, bond prices can decrease when interest rates rise, and limited potential for capital appreciation compared to stocks. The pros of mutual funds are instant diversification across various securities, professional management by fund managers, and accessible to a wide range of investors. The cons of mutual funds are management fees can reduce overall returns. Some funds may have minimum investment requirements. Investors have limited control over specific securities in the fund.
Moving on with more pros and cons. We have the pros of exchange-traded funds are diversification like mutual funds, they're traded on stock exchanges, providing liquidity, and lower expense ratios compared to some mutual funds. The cons, however, are that brokerage commissions may apply when buying or selling, some ETFs may have lower liquidity, impacting trading efficiency, and passive ETFs may lack the potential for active management strategies.
The pros and cons of real estate investment trusts. Pros are they provide exposure to real estate without owning a physical property, and they get regular income through dividends and potential for capital appreciation. The cons are they are vulnerable to real estate market fluctuations, dividend income is taxable, and limited control over a specific real estate asset.
In our next video, we'll be discussing risk and return. We'll go over the explanation of the risk-return trade-off, and we'll understand volatility and its impact on investments.
Thanks for watching. Please like, share, and subscribe, and make sure to fill out the form in the description.